Good afternoon, everybody. Welcome to the Compliance Quarter. Today is Friday, September 11th, and today we are going to be talking about affordability. So thank you, everybody, for bearing with us. I know we shifted from normally being on Thursdays, so we appreciate you all being here, and hopefully you'll get some value from our presentation that we have today. Again, we are going to be talking about affordability, and Angie, our VP of Compliance here at Navigate HCR, has some really awesome information. Just as a side note, you guys are all muted. At the end of the presentation, we will have an open Q&A, so please make sure to stay on and ask us any questions that you guys might have, and you'll be able to unmute yourself or show us you on video, and we'll address those topics. And yeah, so with that, I'm going to go ahead and turn it over to Angie. Angie is not going to be on video today, just so she has make sure that we can see her beautiful slideshow presentation. So Angie, you want to go ahead and take it away?
Thank you, Alex. Welcome, everyone. Thanks for joining us today. And thank you again, as Alex mentioned, for allowing our shift to today instead of yesterday. We will continue to go forward with our normal Thursday presentation. I just had a specific conflict and needed to switch, so I appreciate your flexibility and thanks for joining. As Alex mentioned, we're going to talk about affordability. The reason we're going to talk about affordability is, as most of you probably are in the same boat, gearing up for ACA reporting 2020. I cannot believe we are mid-September already, but this year is flying along, and fourth quarter is always a busy time in the Navigate world because we start really rocking and rolling with ACA reporting. So I thought it was important that we talk a little bit about affordability. When it comes to ACA reporting, affordability is one of the three super important pieces. Failure to adhere to each of those three particular pieces are what generates those very, very ugly and extremely high IRS audits. We have seen lots and lots and lots of them. I haven't checked with the team lately, but I personally have not seen any audits for the reporting year of 2018. So the IRS is still backlogged as usual. COVID did not help in any way, shape, or form. But they are back up, ramping up their audits. So I expect to see some 2018 letters coming down the road shortly. But again, they are still auditing. They had a bit of a reprieve due to COVID, and I've seen those ramp back up yet again. So when it comes to ACA reporting, if you have 50 or more full-time equivalent employees, and we've talked about this in the past, the various government entities that have your fingers, that have their fingers in your business, we talk about COBRA, we've talked about FMLA, leaves of absence, we've talked about IRS reporting. The way to calculate your true size differs for each of those. So today we're going to just talk about IRS reporting and the count. So they essentially are saying if you have 50 or more full-time equivalent employees, you must report to them. Now, if you have any amount of employees and you have a self-insured benefit plan, you must also report. So those are kind of the two triggers to who reports and who doesn't. Once we know that we have to report, well, our reporting is based on benefit plans. Are you offering to at least 95% of the eligible full-time employees, which as we know, when ACA was passed many years ago, now I can say many years ago, what they were looking at is some terminology changes. Forever and a day, we've talked about someone who is full-time versus someone who is part-time. But in reality, with the ACA, they kind of amended that verbiage a little bit. So now we look at who is benefit eligible and who's not benefit eligible. So again, that's why they look at the full-time equivalency counts, because someone may not truly be termed full-time. They may have no expectation of being treated with all the perks and fun of a full-time employee, but they may become benefit eligible based on the number of hours that they work. So now that we've covered those pieces, let's talk about these 3 specific areas that if you are required to report, then your benefit plan must meet the minimum essential coverage. It must meet minimum value. It also must be affordable. So minimum essential coverage, there are, I don't know, 14 or so pieces that every insurance policy must include to qualify as minimum essential coverage. Now, if you're purchasing your benefit plans from a broker who is working with an insurance carrier, if you have a fully insured plan or a fully funded plan, you can be confident that include minimum essential coverage. Minimum value, which often gets confused with being affordable, minimum value really goes back to back in the day when ACA first came around. You probably will remember that they classified different types of benefit plans as bronze level, silver, gold, platinum. Minimum value basically means that that plan has to fall in line with what is considered a bronze plan. A bronze plan must pay at least 60% of the costs of those benefits. So MEC, MV, if you're on a traditional fully funded plan, you're good to go. Affordable coverage is based on how much you're charging the employee for their contribution to the premium. Now, it's very rare in this day and age, at least in my humble opinion, to find a employer who doesn't charge anything or charges very, very little. It used to be far more prevalent in our world because the cost of benefits wasn't so astronomical back in the day. And a lot of employers would not charge an employee any contribution towards their plan. But as we know, with the Affordable Care Act, the costs have gone up significantly. So I would wager a guess as to say that probably 85 to 90% of employers are charging some sort of contribution to the employee, which of course is payroll deducted on a pre-tax basis. Why affordability is important is, one, the percentage changes every single year, and there is no rhyme or reason. It doesn't go up every year. It doesn't go down every year. It can go either way every year. And we're going to look shortly at what that looks like. But it's important that we know how to calculate what is affordable. So the majority of this presentation, despite my little short regression into ACA, the majority of this presentation is going to talk a lot about those types of calculations. How do we truly determine if it's affordable or not what we're charging? So let's take a look. Now, I mentioned the percentage changes every single year. Typically, when the government is doing some sort of percentage and it changes every year, they'll say it indexes due to inflation. Well, I don't think that's really the case here. So if we look at the chart on your screen now, 2015 was the first year you were required to do this type of filing. We started at 9.56%. So if you look every single year, that percentage is changing. So it went up for a couple of years, then it went down, back up quite a bit, down again, and back up for 2021. So if you've not seen the newly released percentage for 2021, it is 9.83%. Now, what that means is you cannot charge an employee more than 9.83% towards their benefit plan. Well, how do we calculate that? Let's take a look. I've got some examples. Now, before we dive into that, the reason for affordability is when we're doing the ACA reporting, we've got to choose what safe harbor did we use to calculate our affordability. Did we use rate of pay? Did we use W-2? Or did we use FPL? You'll hear me say that quite a bit, which stands for federal poverty level. It's very important as we go through some examples here in the next few slides that you understand one key concept. Affordability is used for the employee only and your base plan. So if you have only one plan, one medical plan that you offer to your employees, you have nothing else, it's one plan, one or nothing, that's considered your base plan. If you have multiple plans that they can choose from, you need to figure out which is your base plan, because that's how we calculate affordability. Now, if you have multiple plans, the base plan is usually the highest deductible and the cheapest plan. That's how you can kind of back into what is your base plan. So if an employee chooses one of your buy-up plans, they decide, I want one of the more expensive plans based on my particular needs, you're still only calculating affordability based on the base plan, not the buy-up that they have chosen, because that's an option. They don't have to choose it. The only plan that is important for calculating affordability is that base plan, your lowest cost plan, which is generally your highest deductible plan. Doesn't always happen that way, but usually your least expensive plan is the one you can bank on as being the base plan. So we've got 3 different safe harbors. Let's talk about how do we calculate affordability if I'm using the rate of pay safe harbor. Rate of pay safe harbor is probably one of the most popular, widely used, and easiest to use, whether your employees are salary or hourly. It doesn't really matter. You can utilize rate of pay. So in order to utilize rate of pay, you need to start with either the hourly rate, or if it's a salaried employee, you want to divide their annual salary by 12. You want to take the safe harbor number of hours, which is 130. So we've got our employee's wage, whether it's their hourly rate or 12 months, divided by 12 if they're salaried. You want to multiply that by 130 hours. Then you want to multiply that by the affordability percentage. So let's take a look at an example. Hourly rate, $12.75 is what they make an hour. We're going to multiply that by 130 hours. 130 hours is the minimum number of hours that an employee needs to work to be benefit eligible. So that comes out to $1,657.50. Now that I have that figure, I need to multiply that by our affordability percentage for the year that we're in. Now I'm using 9.78 because that's the 2020 percentage. Now once I have that amount, I need to, I'm sorry, this is on a monthly calculation. I was fixing to divide that by 12, but we don't have to. So 1657.50 times 9.78% gives us a value of $162.10. Now, I've come to that number. What does that mean? That means that in this situation, this example, you cannot charge your employee more than $162.10 per month towards their benefits. Now that's the base plan. That's how we maintain affordability. Now, let's say the employee wants to add their spouse and children to the base plan. That's okay. The IRS doesn't really care how much extra the employee is required to pay to add spouse or dependents. The other factor that we need to consider is, let's say the employee says, well, I don't want the base plan. I want to go to your buy-up plan that you have available. And that buy-up plan is obviously going to be a higher cost. Again, the IRS doesn't care. If you're charging them more so that they can have the buy-up plan, that's okay. As long as you're reporting on the fact that you did not charge them more than $162.10 per month towards your base plan, then that's all that really matters. Again, you are absolutely able to charge additional for them adding spouse or dependents. You're also able to charge more if they're utilizing or electing a buy-up plan. The IRS is only concerned about the base plan and the employee only. The reason for that is, although affordability and different things when it comes to ACA is based on household income, as an employer, you have no idea what your employee's household income looks like. So all you can do is follow the rules based on what you know, which is what's the affordability percentage. How does that calculate out based on any particular employee as an individual? Because you have no idea how to be affordable for an employee's family when the only information you have at your fingertips is how much the employee makes. So I hope that clears that up. Again, feel free to drop a question in the chat box as you think of it. We will take some time at the end to go through any questions that you have. All right, let's take a look at the W-2 option. A lot of folks think, well, all my employees are salaried, so I should use the W-2 option. Well, where that gets to be a problem and gets tricky is you either have to use the prior year W-2 box 1 value, or you have to wait till the end of the year. And if you wait till the end of the year, you could very well have been unaffordable for an entire year, and we definitely don't want that. Now, if you're using a W-2 as the W-2 is your safe harbor, you're going to take the W-2 box 1 figure. In our example, we're going to use $62,300. That's the employee's W-2 box 1 from the prior year. You're going to multiply that by our 2020, for example, percentage of 9.78. That gives us a value of $6,092.94. Now we need to divide that by 12 so we know how much can we charge the employee towards their contribution per month. Now, your payroll is probably bi-weekly or semi-monthly or some other facet out there. I don't think a lot of people use a monthly payroll cycle. It's usually way less than that. But the IRS is looking for reporting based on monthly. So that's why I'm always going to calculate this out. Now, if you're doing 26 pay periods, you can take that 507.75, multiply it by 12, divide by 26, or we already had the annual 6,092. You know, divide it out. Just make sure you're comfortable that you've started with a monthly calculation, because again, that's what you need to report on. W-2 is probably one of the least chosen methods to do affordability calculations. And remember, we looked at that chart in the beginning of the presentation. Those percentages, they go up and down, up and down. It's different every year. So always make sure you're fully informed of what the prior percentages were and what they are going forward as they get published. Now, obviously, the most fun, most favorite, if you can possibly use it, is the federal poverty level safe harbor. This one is its own animal. So let me talk a little bit about what it looks like. In order to determine the FPL, you have to start with the mainland federal poverty level that HHS puts out. You want to get that value for a family of one, because again, you only know enough about your employees. We don't need to look at, okay, well, this particular employee has 3 children and a wife, so I'm a family of 5. We don't look at that. This is only based on employee only. So the published FPL for 2020 is $12,760. Now, what that means is anybody that makes that much or less is under federal poverty level. So if we take the $12,760, again, this is not your employee's wage. This is the mainland federal poverty level. If we take that value and we multiply it by our affordability percentage, again, for 2020 is 9.78. Then we divide that by 12, because again, we want to see the monthly calculation. That gives us $101.79 as the monthly maximum that you can ask an employee to contribute for employee only base plan, contribute to the premium. Now, why is this important is if you are an employer that charges less than $101.79. So let's say, for example, doesn't matter what your employees make, you only charge them $30 a pay, or you're charging them less than $101.79 per month. You can actually utilize the federal poverty level safe harbor, which is far easier when you're doing your ACA reporting. Now, why is it far easier, you ask? I will tell you. It's far easier because if you've ever looked at the coding on a 1095 form, line 14 is the offer code. If you are under federal poverty level in the contribution value, so you're under that 101.79, you get to choose a 1A on the 1095 forms. And let's just look at one here. You get to choose a 1A. 1A means you offered coverage and the rate of the contribution per month was less than 101.79. You don't have to put any value in line 15 because the code itself, the definition of the 1A code itself says you offered coverage, it was minimum essential coverage, minimum value, and under the 101.79. They don't care what it was, as long as it was under that value. So if you're charging $30 a month, the IRS doesn't care. They know that based on the use of a 1A. Now, if you're not using the federal poverty level because you charge more than 101.79, let's say, for example, you're using the rate of pay safe harbor, your line 14 code for someone that you offered coverage to would be a 1E. A 1E is telling the IRS that yes, you offered, yes, it was minimum essential coverage, yes, it was minimum value, but it was more than the federal poverty limit. Then they want to see your rate. It's super important that you remember when you're filling out line 15, it's based on the base plan that you offer and the employee only or single rate of contribution per month. Even if the employee added their spouse and kids and they went to your buy-up plan, the IRS does not care what they're paying extra for all of those other features. They only want to confirm with you from this filing that you were affordable had they chosen employee only base plan. All right, That is affordability in a nutshell. 30 minutes, I got it out there. Super excited about that because I could talk about a lot of things for a lot of time. Affordability tends to be a tricky one for folks. Where it gets really wonky is if you're in a state where smaller group sizes get age banded rates. Age banded rates are kind of the bane of my existence. And if you are on this call and you are a broker, you feel my pain because you experience it. Where it gets really tricky, and I swear it's considered reverse discrimination sometimes, is if you have an employee who's 35 years old, you have another employee who does exactly the same job and makes exactly the same money, but is 55, and you have age banded rates. I'm sure you've seen this. The 55-year-old's rate is way higher than the 35-year-old's rate. And it's super important that if you're dealing with age banded rates, that you're watching the contribution, you're watching that affordability. So age banded rates, older folks, it gets tricky. As well as if you have hourly employees, so they're not on salary, they're hourly, and they make a relatively low value, or they're at minimum wage or just above, you always want to double check your affordability calculations. So I often look at my older population as well as what is my lowest employee making, and I look at affordability there. Now, it's a fabulous rule of thumb. If you are, you're higher in your contribution level, you should check affordability for every employee. Document that you've done that. So with that, I'm going to wrap it up and take some questions. You can either type it in the chat. You feel free to unmute yourself and ask away. I'm here to support you. And I'm going to take a drink while I'm waiting.
Show us your beautiful faces if you can. Angie, we did have a question that I got that came in.
Okay.
Let's see, I'm going to read it. If a plan is a high deductible health plan, either an HRA where the employer pays most of the deductible, or an HSA where the employer contributes towards the plan, how can you determine whether or not it has minimum value?
So it's, even though there's a deductible and different things like that, there's co-insurance and all of that stuff. What you want to look at is the structure of the entire plan itself. So there are rules around how high can the deductible be, before it's just completely out of whack. But again, if you're utilizing a broker who is working with an insurance carrier on a fully funded plan, meaning when I say, just let me clarify this in case you're unaware, fully funded plan is a typical health insurance plan where you pay the premium and essentially transfer all your risk into that premium. It's the insurance company who's going to pay the claims to the providers. If you utilize a self-insured plan, what that generally means is the employer agrees to assume some of the risk of claims for a lower premium cost. So they're hedging their bets. They're taking on some of the risk. In a typical self-insured plan, the employer is going to be responsible for the first $50,000 or $100,000 worth of claims before a carrier or stop loss is going to kick in and start paying the rest. So if you have a traditional fully funded plan, or if it's even partially self-funded, like your concept of an HSA or an HRA type of situation, you need to look at the back end of the plan. And even if it's partially self-funded with an HRA type of situation or HSA situation, the chassis of the plan itself should have to be considered minimum value because it's coming from an insurance carrier. Where you need to be careful of something not being minimum value is something that's designed outside of the scope, like in a self-insured type of situation where you're not working with a stop-loss carrier, things like that you've got to be a little worried about. But if you're purchasing an out-of-the-box type of plan that an insurance company is selling to you through your broker or otherwise, then that should be absolutely be minimum value, or the carrier would not have been able to file for it and have it approved in your state. I think where, I'll just throw this in as well, where minimum value and minimum essential coverage was a little tricky was in the beginning of the ACA years. And we had grandfathered plans and grandmothered plans and different things like that. And people were creating all kinds of interesting plans right before ACA hit. We had those kind of skinny plans or mini med type of plans. Those are not going to be considered minimum value or minimum essential coverage. Thanks. That was a long-winded answer. What else you got, Alex?
So there's a couple more that go along with that. And then is the work week 40 hours or 30 hours to figure out affordability?
If you're using a safe harbor, which you need to, then you need to use the 130 hours per month. So although your employee may work 40 hours a week, 45 hours a week, unless you want to track every single week or month exactly how many hours they're working and do a true calculation at that time, it's recommended you use a safe harbor and then you utilize the 130 hours.
Okay. And then one more I have here, and it says, if you charge less, do you report the actual charge or the 9.83%?
You report the actual charge. So if in our example, it was $162.10, but you only charged $115, you would report the $115.
All I got at this point. Does anybody else have any other questions or anything else that has to do with anything else? Pick Angie's brain. Now's the time.
Anything about anything, right, Alex?
Anything about anything.
Compliance. How about that?
Oh, come on, you guys.
I know. It's Friday afternoon. I get it. I get it. All right. Well, perfect. As always, guys, if you have questions that come up after, certainly if you have questions that come up while you're starting to work on your ACA reporting, or you go back next week and you're taking a look and double checking your affordability or anything of the nature, we're here. Reach out to us. We're an email away. And we can help you out. So I know things come up as you're doing them. They may not come up in the midst of a presentation or a speaking event. So as you're doing stuff, you come up with a question or an issue, reach out, shoot us an email. We're happy to support you in any way we can. Alex, do you want to wrap us up?
Yep. So thanks everybody for hopping on this afternoon. We're super grateful. And again, we thank you for bearing with our shift for this month. I will go ahead and once everything is uploaded, I will send out an email as a thank you along with the link for today's recording, as well as all of our previous shows. So feel free to like and share those wherever you think applicable, especially these affordability and the ACA ones. It's getting to be that time. So we are, like Angie said, we are definitely here to support you all. We want to be a good resource for everybody. So with that, please let us know if there's anything that we can support you with, either if you're a client or if you have clients that might need some help. We are always here. And happy Friday afternoon and have a good weekend. We'll see you guys all next month. Bye.
Thanks, everybody. Bye.